Welcome to Iron Financial, the place where we help you forge a stronger portfolio and cut right through all that market weakness. Today we are doing a complete teardown on NIO. You have to listen to this because the company just dropped a Q4 earnings report that has sent an absolute shockwave through the market. Seriously, it's forcing every single bull and every single bear to go back to the drawing board and rethink their entire thesis. The numbers are out, the battle lines are officially drawn. Okay, let's get right into it. This right here, this is the headline that sent a jolt of electricity through the market. I mean, for years, and you know this, the entire story around NIO has been about cash burn. It's been about their ambitious, maybe even crazy plans, and this long road to maybe, someday, breaking even. Well, guess what? That road might have just come to an abrupt end. The key phrase here, the one that changes literally everything, is first ever operating profit. Look, this isn't just another data point on a spreadsheet. This is a milestone. This could be the moment the company finally forged a new, solid foundation of actual financial strength. And right here, this is the market's instant reaction. Its immediate verdict. We're talking a nearly 7% surge in pre-market trading. Now let's be clear, that's not just retail hype pushing a stock around. No way. When you see a move like that, you're looking at big money. Institutional money, waking up, smelling the coffee, and aggressively repricing this stock in real time. The market is screaming at us in no uncertain terms that it believes a fundamental, structural piece of this company's financial story has just been locked into place. It's a powerful, decisive, and very loud reaction. Whoa, hold on a second. Let's pump the brakes. A big pre-market pop is great, it gets the blood pumping, but let's not get carried away just yet. The real question, the one we have to answer today, is whether this is a durable, permanent, structural shift in how this company operates, or was this just a fluke, a one-time bit of luck, a single great quarter that they can't possibly repeat. We need to know if the foundation they just laid is built on solid bedrock or if it's sitting on a pile of sand that's about to wash away. That's what we have to dig in and figure out. Exactly, and that's our game plan for today. We're going to start by dissecting the numbers behind this profitability shockwave. Then we are going to meticulously construct the full bull case. We're calling it Forging a Fortress. After we've built it, we're going to stress test that fortress. We're going to look for any cracks in the armor. From there, we'll analyze the CEO's absolutely massive bet on the company's future, and then finally, we're going to weigh all the evidence and deliver our verdict. Is NIO now a generational buying opportunity, or is it a very, very dangerous trap? All right, let's get to it. We're going to build this bull case from the ground up, starting with the hard numbers, the cold facts. The strength of any industrial company, any company at all really, begins with its top line, its revenue. We have to see if the engine is not just running, but if it's actually accelerating. Because everything that follows, the margins, the profits, the cash flow, all of it is built on this one foundation, revenue. And wow, what a foundation it is. Total revenues for the quarter hit 34.65 billion yuan. To put that in perspective for you, that's just under $5 billion in a single quarter. This is not some small cap company having a lucky break. This is a massive global industrial operation that is firing on all cylinders. The sheer scale here proves one critical thing. They can produce and they can sell cars at a high volume in what is probably the most brutally competitive auto market on the planet. Now, look at the speed of that growth. Check out the velocity here, a 76% increase year over year. Think about that. In an economic environment that is filled with headlines about an EV slowdown and weakening demand, for NIO to post this kind of acceleration, well, that is a testament to raw, brutal execution. This isn't just the market lifting all boats. This is NIO actively taking market share and flexing its operational muscle. This is the kind of heavy lifting that separates the eventual winners from the losers. And here's the engine driving that revenue growth. Almost 125,000 vehicles delivered in a single 3-month period. That is up a staggering 72% from the same time last year. What this proves, beyond a shadow of a doubt, is that the demand for their cars is robust. This isn't some kind of financial engineering or accounting trickery. This is the direct result of building cars that people actually want and having a system to get those cars to customers. It's the absolute core of any successful automaker. Okay, so this is where the story gets really, really compelling. How did this incredible performance stack up against what Wall Street was expecting? Well, NIO didn't just meet expectations, it completely demolished them. The revenue beat was solid, sure. But look at that EPS line. Look at it. Wall Street was forecasting a loss. The so-called experts expected the cash burn machine to keep on burning. Instead, NIO flipped the script and delivered a real, actual profit of nearly 7 cents per share. This is a dramatic swing that proves one thing. The market fundamentally misunderstood the progress this company was making on controlling its costs. They got it wrong.
And here's exactly how they did it. Gross margin. This is the critical link between revenue and profit, and it expanded significantly from 11.7% all the way up to 17.5%. This is so important because it shows they're not just selling more cars by discounting them to death. No, they're actually making more money on every single car they sell. This points directly to better cost controls, manufacturing efficiencies from getting bigger, and almost certainly lower battery costs. They are finally turning that raw revenue into hard, tangible profit.
And all of that hard work, all that execution, it all culminates in this one number. The first ever adjusted operating profit, 1.25 billion yuan. Let's be crystal clear about what this is. This is not some accounting gimmick. This metric strips out all the noise, things like interest payments or one-time gains, and it measures the pure, unadulterated health of the core business, which is designing, building, and selling cars. For years, this number has been a big, fat negative. The fact that it has finally crossed over into positive territory is without a doubt the single most important inflection point in this company's entire history. This is the moment the business model was finally proven to work.
Okay, that is a very solid case, built on a very, very strong quarter. Nobody can argue with those Q4 numbers. They are what they are. But here's the thing, earnings reports are a look in the rear-view mirror. We're investing for the future, not the past. So now it's time to take a sledgehammer to this beautiful fortress you've just built and see if we can find any cracks in the armor, because one strong quarter does not guarantee a victorious war.
And you know what? We don't have to look very far to find the first major crack. Let's just compare the blowout Q4 deliveries with the guidance they just gave for the first quarter of 2026. They're telling the market to expect a range of 80,000 to 83,000 vehicles. The street was expecting almost 89,000. That is not a small miss, my friends. That is a significant drop-off from the fourth quarter, and it's a major disappointment compared to what analysts were looking for. After posting 72% year-over-year growth, this guidance looks incredibly, shockingly weak.
And it's not just me saying this. Listen to analyst Arun George on Smart Karma, who, by the way, has a short thesis on the company. He points directly to this weak guidance as clear evidence of declining sales momentum. That's the killer phrase right there. In a growth story stock like NIO, momentum is literally everything. The second it stalls, the entire narrative, the entire bull case comes into question. This is a major, flashing red flag.
And that weak guidance, it translates directly to the bottom line. Just look at what Wall Street is now forecasting for the rest of 2026. After that one glorious, profitable quarter, the consensus view is that NIO swings right back to a massive loss. I mean, they're projecting a loss of 92 cents per share in Q1 alone, and a loss of over $2 per share for the full year. What analysts are telling us, loud and clear, is that they believe Q4 was the exception, not the new rule. They think the party's already over.
If we pull back and look at the bigger picture, this data from Smart Karma paints a pretty mediocre picture of the company's fundamentals. The overall score is a weak 2.2 out of 5. And if you look closer at the components, sure, growth and resilience are okay, a 3. But value and momentum score a pitiful 2 out of 5. This suggests the stock isn't even particularly cheap, and as we just saw from their own guidance, the momentum is questionable at best. This is not the profile of a company that has just hit some amazing, sustainable turning point. It looks a lot more like a company that's still facing some really significant struggles.
Those are all fair points. They are valid, and they represent the absolute core of the bear case right now. But there's another piece to this entire puzzle that we have to consider, and it might just be the most important long-term signal of all. This isn't about one quarter's guidance. This is about the next decade. Let's talk about the massive, and I mean massive, new share incentive plan for the CEO, Bin Lee. This is his personal billion-dollar bet on the future of this company.
So let's start with the sheer scale of this plan, because it's hard to wrap your head around. The board has authorized a grant of over 248 million restricted share units, or RSUs, which are basically shares that are awarded over time directly to the CEO. Now let's be absolutely clear what this means. This represents a staggering 10% of the company's total outstanding shares. This isn't your standard annual bonus, folks. This is a colossal, company-altering grant that is designed to completely weld the CEO's financial destiny to that of the company itself. Now, crucially, these shares aren't just handed to him on a silver platter. Not at all. They are entirely performance-based, and they're split into 10 different tranches with incredibly aggressive targets. I mean, look at these numbers. For him to get all of his shares, the company's market cap has to climb all the way to 120 billion US dollars, and the annual net profit has to reach $6 billion. These are not easy hurdles. This structure forces the CEO to create absolutely monumental shareholder value just to get paid. His incentives are now perfectly, almost surgically, welded to the shareholders.
And here it is. This is the final, critical piece of the puzzle that truly reinforces this alignment. Ben Lee has irrevocably, that means he can't back out, he has irrevocably agreed not to sell, transfer, or get rid of any of the vested shares for a full 5 years after each tranche vests. I want you to think about that for a second. Even after hitting these insane, incredible targets, he can't just cash out and buy a yacht. He is contractually bound to remain a long-term owner, weathering the exact same storms as every other single shareholder. This is the absolute definition of having skin in the game.
You know, I see the argument for alignment. I really do. It's compelling. But we have to look at the other side of this coin. Authorizing an amount of shares that equals 10% of the entire company, that is a massive potential dilution event for every single person who owns a share today. So the question becomes, is this a brilliant move to create the ultimate alignment of interest between the CEO and the owners, or is this just setting up the very people who own the company today for a huge haircut on their ownership stake down the road, even if the company succeeds? It's a really, really high-stakes gamble.
And that brings us right to the final verdict. We've laid out the foundation of the bull case, and it's built on a landmark profitable quarter. We've taken a sledgehammer to it and identified the very real cracks in the armor. And we've examined the CEO's massive long-term bet. So now it's time to put it all on the scale, weigh the evidence, and decide if NIO, right here, right now, represents a powerful opportunity or a very well-disguised trap.
So here it is. This is where the battle lines are drawn. The bull thesis is built on tangible, historic, undeniable results: a proven profitable quarter, explosive top-line growth, expanding margins, and a CEO who is all in for the long, long haul. The bear thesis, on the other hand, is built entirely on forward-looking risk: weak guidance, negative analyst forecasts, the potential for huge dilution, and a shaky, brutal macro environment in China. It really just boils down to a conflict between proven execution in the past and significant uncertainty about the future. The question is, which force is stronger?
Look, this is not a simple call. It's not black and white. So for any investor out there looking at NIO right now, here is your checklist. These are the things you have to watch. First, watch the Q1 and Q2 delivery numbers like a hawk. You need to see if that weak guidance was just them being conservative or if it's a sign of a real decline. Second, monitor those gross margins. Was Q4's efficiency a one-off or is it sustainable? Third, track their progress towards breaking even in 2026. And finally, pay extremely close attention to the rollout of their new mass market brands Onvo and Firefly and the state of EV competition in China. The outcome of this entire battle will be decided by these key metrics. Ultimately, it all comes down to this one question. NIO proved in the fourth quarter that it could forge a new suit of financial armor. They proved they can be profitable. We know that now. But the EV market, especially in China, is an absolute war zone. You have new competitors, brutal price cuts, new technology. It's a battle every single day. So the question you have to answer for your own portfolio is simple. Is the armor they just built strong enough for the wars that are still to come?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.